The market has been moving within a narrow range, 24,500, 25,500 range during the last 2 months. There has been no triggers for a breakdown below 24,500 and a clear breakout above 25,500. What should investors do in this narrow range-bound market? Welcome to Geojit Spotlight. First, how do we explain this range-bound behavior of the market? The strong support for the market in recent years has been coming from domestic investors. Retail investors have been buying every dip, and domestic institutional investors, flush with funds flowing through SIPs, have been regularly buying in the market. This domestic buying has been supporting the market even when fundamentals turned weak. This domestic buying prevented a breakdown in the market. On the contrary, the FII activity has been characterized by alternate bounds of buying and selling. In the first 3 months of this year, January, February and March, FIIs were sellers in the market. In January and February, they sold heavily. In the next 3 months, April, May and June, FIIs bought. But in July, again they have started selling. Apart from selling in the market, in the cash market, they have gone short in the derivatives market too. This is the principal reason why the market has turned weak. From the fundamental perspective, the biggest challenge the market is facing now is the poor earnings growth. Last year, in FY25, earnings growth was poor at around 5% for NSE 500 companies. This year, in FY26, earnings growth is expected to be around 10%. In such a poor earnings scenario, the market is unlikely to turn bullish. Nifty is now trading at a PE multiple of 22 times. It is hard to justify such a high PE in a tepid earnings growth scenario. It is very important to note that this is a short-term scenario. This will change when fundamentals change for the better. As I have explained in earlier videos, in India, now we have a paradoxical situation of strong macros but weak micros. Macros like GDP growth, fiscal and current account deficits, inflation, fiscal and monetary policies, all these are positive. But these positives are not reflecting in micros. That is, these positive macros are not spilling over to improved earnings. This might take time, but will certainly happen. Therefore, investors should take a medium to long-term view. Remain invested in the market, continue to invest systematically. Additional investable funds may be allocated between equity, fixed income and gold. The near term may be a bit challenging, but equity will certainly outperform in the medium to long run. This is the historical experience.